All right, so these are the accounts affected when you have a return of goods. All right, and we are just going to focus on this red color box. We are just going to focus on this box here and record what happens when your customer, what happens to the cost price when your customer return your goods. So this example here, credit customer return $70 inventory and the cost of the inventory is $60. How do I know that $60 is the cost? Because the other number, $70, is higher than $60. And the higher number is usually the selling price. The lower one is usually the cost price. Another clue is because of this word here, cost. All right, so I'm going to record this blue color cost of inventory first. And I remember in my previous slide that when my customer return inventory to me, I have more inventory in my business now, in my warehouse. So I am going to record inventory increase by $60. Asset increase by $60. What happened to the other account? Now, the other account affected is cost of sales went down, expenses went down. Now, you remember last time, cost of sales went up, right? You recorded in the plus in the equity minus column. So this time, when cost of sales go down, you will record it in the equity plus column. All right. Okay, so now we're done with the cost of sales. We recorded it. We want to record the selling price. Now, how is the transaction of the selling price when the customer return the goods to you? How do you record this in your accounting equation? Firstly, because the customer is not going to pay you, you will record a trade receivable minus $70. Your asset went down by $70. Your customer is no longer going to pay you. What is the next account? What is the best friend, right? Sales return. But where are we going to put sales return? Hey, where are we going to put sales return? So just to let you know what sales return is, basically sales return is inventory that is sent back by a buyer to the seller. So your buyer sent back the inventory to the seller. All right, it's as though he never bought it. I don't want to buy it, it's so crappy. All right, and he sent it back to the seller. So sales return, we need to know a few things. Sales return is a contra income. What does a contra income mean? A contra income means that it is the opposite of income and it reduces income. So instead of income plus, you will record minus income. Okay, you will record minus income. And when that happens, the seller issues the buyer a debit note. Buyer, please take this debit note and please know that I am reducing the amount that you owe me because I am reducing the amount that I sold to you. So it's a reduction of income. Debit income, debit note. It's a debit note, right? It reduces income. So if it reduces income, how does it look like on my expanded accounting equation? If I have an increase in sales returns, it is shown under income. And for OE, assuming everything else remain constant again, when OE, when there is a sales return, and we must always remember sales return reduces the income, so we put a minus sign in front of the $70 because we know that it reduces income. So OE will minus $70 when there is an increase of sales return. So where do I put this sales return, right? OE minus $70 when sales return increase $70. So this is how I will record it. My sales return will go into my equity column, minus sign, because equity will reduce by $70. when there is more sales return. So I'm going to check my accounting equation again. My asset plus 60, my trade and my asset also minus 70. Asset equals to negative $10. My equity minus 60. My equity plus 60 because in the plus column. And my equity minus 70. So overall, my equity minus 10. Asset equals to L plus OE. The accounting equation is balanced. I have to remind us again that trade inventory and cost of sales is a pair. Trade receivable and sales return is a pair. You cannot separate them. Okay, so what you're going to do is you're going to try the next activity on SLS.